hey, I can't control what the market is. I can't control how I'm invested. I can control what's my reaction when the markets go down. Welcome to the Live Greater View, a financial planning podcast produced by VLP Financial Advisors that discusses life, money, and perspective. We help clients live their best life at every stage through our VLP Live Greater partnership process. Thank you for tuning in. Welcome back. I'm Rose Price, a certified financial planner and partner here at VLP Financial Advisors.
I'm Dan Lash, also a certified financial planner with VLP.
And we have a great topic today, retiring in a bear market, timely, as we're here in the spring of 2025 and got a little bit of volatility in the market. And we'd like to remind you, if you have any questions that you'd like the advisors to answer or cover, please visit our website or go to send an email to info@vlpfa.com, and we'd be happy to have it in some of our future podcasts.
Love questions.
Yeah. So Dan, let's start with what really is a bear market. Let's define for clients and listeners really what that is.
Well, I don't know where it originated.
Yeah.
I don't know who came up with the term. I'm sure it was like somewhere in the 1930s or 20s or when the
bull and the bear were running down Wall Street.
Yeah, exactly. So typically defined as a drop in the market, in the stock market, of 20%, and not over any particular
right, not calendar year.
Right.
No.
Any sort of period of time. If it's 10%, they call it a correction.
Yep. Doesn't sound bad.
It doesn't feel correct if you're losing money, but that's the typical definition of it. And we're not officially in a bear market currently. Yeah. And that's, if you got to look at a broad index like the S&P 500, something that's pretty broad. Now, there are certain areas of the market that you would say are in a bear market.
Sectors.
Yeah, certain sectors. But in general, we're not quite there yet, and the hope is we don't get there.
Yeah.
But it's a possibility.
Let's talk a little bit about what leads to bear markets. A lot of times this is when you see investor sentiment start to decrease, where they're concerned with whether maybe cost of goods are going to go up. Is inflation going to be an issue? Unemployment. Certainly things that impact the economy, where people start to think, hey, things don't look as good as they did maybe 5 months ago, a year or so.
Yeah, there can be multiple reasons why things occur that lead towards these bear markets. I mean, if we go back, say, 25 years ago, it was let's say the overinflated prices of stocks that weren't going to make any money.
Tech stock,
the tech bubble. The tech bubble, right?
Yep, early 2000s.
Pets.com was a great idea.
Yeah.
And then we now have Chewy, which is funny because, they figured out how to make money. Then in 2007, it was, maybe housing prices are too overinflated. So it usually has to do something with overinflated prices of some sector of the market that then sort of expands and affects other areas. And you could say towards the end of 2024 that certain areas of the market were overinflated. Yeah,
certainly if you look at PE ratios, certain parts of the market looked expensive compared to where they were a couple years ago.
Yeah. Mainly in the tech sector because that's what's done
really
exceptionally well.
Yeah.
But I don't think it's the same as what we saw 25 years ago. These companies are actually making money.
Yeah. And the difference is, too, sometimes it's due to regulation or lack of, right? Part of what we saw in the housing crisis was a lack of regulation where anyone could go in and get a mortgage with no income, no documents, no nothing. Yeah. And, of course, if you're going out and buying a $700,000 house and you make $20,000, this could potentially be an issue, which is what we saw. And same with, the tech bubble. You had companies there was just money coming in for these ideas and these new .coms that really had no idea how to get off the ground.
Yeah.
So.
And then there's economic factors, and we move through cycles where interest rates are low, and we saw that in 2022 when they were raising interest rates and bond prices were going down. That was the worst bond market in like 50 years.
Yep.
That was a tough period of time to be an investor because the area that you tend to invest in that doesn't correlate or move the same as the stock market is typically bonds.
Yeah, was also impacted.
And you're negative there too, and you're like, oh, where do I go?
Yeah. So this really where we're segueing into is this really becomes an issue and mentally for clients and emotionally when they start thinking about retiring and we enter these bear markets. We tend to see, the headlines will be like, I can't retire, my 401k just went down X, or I've lost so much money in the market. And this is really where planning comes into play. If you've built a plan, if you've thought through, we know it's not a matter if, it's just when, right? There are going to be bear markets. We could look back since started tracking the stock market in the early 1900s. They're going to come. They usually come when people don't expect it, right? Hence, there's this volatility scenario. But really, it's talking about where, how do you plan for these? So if you've already chosen that retirement date, you can still move forward.
Well, certainly, planning for the most expensive thing you're going to do in life,
right? Yeah,
is probably a pretty smart thing to do, right? Because if you look at it and you go, well, I'm going to spend $75,000 a year in retirement or $50,000, and you go, okay, well, how long are you going to be alive? Let's multiply that by that number,
right.
And then we have inflation. You go, you're going to spend a ton of money,
yeah.
And so then you want to say, well, how did I plan for that?
Right.
And I see a lot of the concern starts happening if they're around 5-ish years away.
Yep.
And something like the current market happens. That's when you start seeing people go, oh, well, what's happening? Or if they literally just retired on January, let's just go with
January 1,
2025.
Yeah.
That was their December 31st, whatever their date was. Right. And they're going, well, what do I do now?
Right.
And you go, well, nothing. It's no different than if the market went up. We have a plan for that.
Right. And that's where we really talk about diversification, right? If you were like, oh, it's great, I can retire because I've owned all these tech stocks and they've done so extremely well. But come January and now fast forward to May, and you've seen them, pull back 20, 30%, you got to have other pieces of the portfolio that are going to hold up or generate income. And that's where, how much do you want to keep in cash? What do you keep in bonds? Because if you can plan for that and you have a strategy, retiring during a bear market is actually an opportunity, not a, hindrance.
No, I mean, you just got to make sure that you're distributing or taking money out of the appropriate investments at the appropriate time.
Yeah.
Right? Last year, you were going, oh, I'm going to take, if I was retired last year, I'm selling stocks because they're up 20, 30%.
Yep.
Well, there were certain areas that weren't up as much, but even then, you dial in even more. You go, well, I have lots of different stock funds or ETFs or mutual funds, whatever it is, and you go, well, certain ones did better than others, so I'm going to make sure I take from those.
Yep.
But what a lot of people do is they go, well, I'm going to take from the things that didn't do as well. Because this thing that went really well, that's just going to keep going. And you go, that's just not how things work.
Right.
And so
the story is all this time.
Everything moves in a cycle.
Yeah.
And, the last 5 years, international stocks haven't looked exceptionally well. They've made money.
Enter 2025.
Yeah, exactly.
Yeah.
Where they're positive.
Positive. They're doing better than U.S. stocks.
I was going to say they're doing really well, but I mean, if you're up 3, 4, 5, 6% in April of 2025, you're going in stocks. You're going, that's pretty good because everything else, for the most part, isn't.
Yeah, so it's definitely all about the planning and thinking through, really understanding what are your expenses going to be in retirement. We spend a lot of time in the psychology of how does retirement look for you? Because it's different for every client. Some clients really want to travel. Some traveled a ton for work, don't want to travel. It really boils down to, what does this look to you? What are you going to retire to? How much is that going to cost? And what are the things that are important to you? And if we can understand that and we can back into, our strategy is let's have 5 to 7 years, and we'll talk a little bit about why. 5 to 7 years in that bond and cash position to ride out the volatility in the market. Dan, you brought up 2007 and 8 when we had the housing crisis in the market. From peak to trough, it was a 55% pullback, right? If you had everything in equities, that was a really challenging time. And if you retired, that was a tough period. And I'll tell a story about a client who actually retired in that period and kind of, how we had to work through that and the things we did. But, those are the times where you really have to think about what are my expenses going to look like? And we know from that period, it took about 5.5 years for the S&P to get back to where it was.
Right.
So if you had everything in the S&P and you just retired, you just saw half of your net worth go away.
Right.
And then you need this money to live on, but it's not going to come back, and if you're spending it, it's not coming back in 5.5 years either. Right. So that's a great point, and talk about, hey, what are the other aspects? Because during that period, bonds were positive. Large cap value actually did fairly well. So being diversified and having that strategy can really help you get through those periods.
Yeah. Diversity is interesting in the sense that it allows you to sort of weather these storms, but at the same time, as advisors, it's easy for people to go, well, why didn't you just own this thing?
Why didn't you? Yeah.
That was up here for and then the next year you should have known what the other next thing. Trying to figure out what the next thing is going to be that's the best next thing is impossible, quite frankly.
Yep.
So you own a little bit of everything. You try not to take too much risk in any one area. You don't. The other thing is, conversely, you don't want to be overly conservative.
Correct. Because there's inflation issues.
Right, because in bear markets, people, or while they're in them, they're going, I should be way more conservative. I go, well, we don't want to sell stocks that are down 10% and go buy bonds that are up 2%.
Right.
It's buy low, sell high. That has worked for
years, forever. Yeah.
And so you go, well, we should be more conservative when we're thinking about moving into retirement. And that's probably that part of that planning that we talk about is somewhere in that 5 to 10 year window before retirement, you go, we may want to pare back risk.
Yep.
And so should we be a little more conservative? But then when you meet the clients who go, I don't have enough, I need to be more aggressive,
right,
so I can get to that retirement date. And you step back and you go, okay, well, here that might work.
Correct.
But if it doesn't, are you willing to work
2, 3, 5 more years?
Right.
Yep.
What's more important to you?
Yeah.
Taking that market risk or
being able to retire?
Being able to retire.
Yeah.
And are you willing to work an extra amount of time if that risk doesn't pay off?
And the next question is, what if you can't work, right? What if you have a health issue or something pops up that you're not able to work anymore? We see that from time to time. So you have to think through, okay, what amount of risk are you willing to take? Because to your point, if you wanted to retire at 65, but the market just went down and you were all equity, and now the reality is it's going to be 70, is that feasible?
Yeah.
Is your quality of life, would you have been okay with, would have been better if you just were a little bit more conservative and you can weather that storm? And understanding, hey, I can't control what the market is. I can't control how I'm invested. I can control what's my reaction when the markets go down or non-reaction. For the most part, not all the time, because there's an emotional part to this, right? And let's tell a little about some of our experiences where we've had to weather those storms with clients, because inevitably we always have a client or clients who are retiring and we enter a bear market.
Yeah, it happens all the time.
It happens all the time. Perfect example, I'll use was 2008. We, had a client. Again, this was an area when the housing crisis was hitting. I mean, it was just chaos.
It was bad.
It was bad. I mean, there were days, the market would just go down 2-3% a day for days. And, clients were stressed. We were stressed, but again, we try to start with that planning piece. So we talk to clients about, hey, what are your expenses? What does that spend look like? What are the resources? Do you have a pension? Do you have, what is Social Security going to look like? When can we pull that lever? Are we going to start it right away? Are we going to wait? How much assets do we have in individuals and your qualified or 401k plans? How are they invested? So if we can think through that strategy and say, let's have that 5 to 7 years, you need $70,000 to complement your other income streams. Let's take that 70 and let's build that in across the portfolio and have 5 to 7 years. In some cases, some clients, maybe it'll be 10 years. It really depends on their assets and where they are and their spending. I had this scenario, and this client retired, and we were actually rolling over his 401k in the middle of 2008, beginning of 2008. So the market is just dropping. But when you roll over a 401k, they issue a check, right? Yeah. Everything's sold, a check is sent. And this is great, because the market just started to go down a little bit, and he'll get this check, and now cash came in, and he's traveling across country. And I get a call I think he literally had called me from like a payphone in Arizona or from some scenario like that. don't invest the cash. And I said, all right, let's dollar cost average in because we can use that strategy. That's an area where, we have these periods of volatility where we can, just like in your 401k, we're going to buy pieces over time, right? So we started doing the strategy of buying over time, which worked out great because the market kept going down and we bought more shares, which meant when it recovered, we had more shares working for us. But it really kind of hit the peak in like October, right before the bottom, September of 2008. And the other thing he liked to do was ride his stationary bike and listen to the news, which was not a good thing. I think he was going to have a heart attack. So he called me, he was calling a lot. And finally one day I said, Juan, like, who are your beneficiaries? Because you're going to have a heart attack. Like, if you keep riding your stationary bike, watching the news and worrying about the market, didn't you want to travel? He said, yeah. I said, you know what? Turn off that, go to the travel channel. Call me when you find out the next trip you want. We'll send money. I thought he might fire me, right? This was a contentious conversation because he wanted to be heard. And he did call me back about a week later, and he said he was mad at me, which, rightfully so. But he said he did turn on the travel channel, and now he decided he was going to go to Europe because the dollar was stronger and he could spend more money over there. What ended up happening is from that conversation, which was really hard because emotionally he was concerned. He saw all this money going down. He'd retired. But we had done the planning. We knew we had 10 to 12 years in bonds and cash. He was not going to run out of money. And a matter of fact, instead of taking 5 years to get back to where he was, because we rebalanced, he got back in 3. So again, it's, having that plan and that strategy. And then he went on to travel the world, which, was great. And when he did pass, he passed, millions of dollars to his children. So, it was just one of the times where I was early in my career. This was a tough strategy to have a conversation with a client about, hey, here's where you are. Don't focus on these things, focus on some other things. And, that's really what I think the message is to clients. Like, let us build the plan. We'll manage it. You need to enjoy life.
Yeah. I mean, I think it gets kind of old if somebody's watched our podcast more than once, we go, hey, plan.
Yeah.
If you want to be successful at something, you have to put a plan together.
Right.
Whether you're starting a business or running a marathon or, some other athletic endeavor. And the same is true for, putting your kid through college and retiring, these things that are going to cost a lot of money and last over an extended period of time. Mm-hmm. And so it can be a challenge. Sometimes they'll have to change things. I had a couple who retired in March of 2000. I mean, that was they basically retired the worst time since 1928.
Right.
Because that decade followed.
March 7th was the bottom of the market. Yeah. And then the decade. Yeah.
That next decade, the market returned like zero.
Right.
For 10 years, which most people go, I don't remember that. You go, yeah, I know, but that's kind of what happened.
Yeah.
We recovered from 2000 through 2002, the tech bubble. We recovered by like end of 07 and then
08,
the financial crisis it came into play. So it was difficult. I mean, those clients changed things slightly. They were worried about, can we continue to do the things that we're going to do? Because the down market was down in 2000, down a little more in 2001, down even more in 2002.
Yeah.
And so that's hard to get over.
Yeah.
Fortunately, while they had debt, interest rates came down.
Yeah.
So they were able to refinance. They had a small mortgage on the house and on their boat.
Yeah.
Right? And you're like, okay, well, they'll just refinance that. Well, that brought expenses down on a monthly basis. So you also have to be proactive of, are there other things outside of your portfolio that we can
manage? With? Yep.
And did they travel as much initially as we had planned for? No.
No.
Because it made them feel better not pulling the money out. Even though we said, yeah, you can still probably go and do that. It's not going to be a problem. But extended bull or bear markets can concern people a whole lot more. Like 2020, for example.
Yeah.
We're in a bear market in the first 3 months of the year.
Right, with the COVID crisis.
We're all going to die of COVID. And so the world's coming to an end and stocks just tanked. Like 4 months later, almost everything had recovered.
Yeah.
Certain stocks hadn't, but the market in general. And it happened so quickly, people didn't even notice it.
Right.
But some of these other ones that sort of last a little longer, people go, hey, I think things are bad.
Right.
Yeah, they are. But we'll be fine.
We'll be okay.
We'll be fine.
And to that point, 2001 and 2002, really you're pointing more to like the S&P. If you owned just large cap value stocks, you actually did okay.
Yeah.
So that goes back to,
hence the tech bubble.
Hence the tech yeah. So yeah, I mean, it's certainly, that goes back to that diversification and having a plan, as Dan alluded to. It's all about starting with that planning side of things. So
plan.
Yeah.
Can't say it enough. Anybody, you'll hear, I'll hear from friends and things like that. They're like, oh, my friend, is retiring. And I always wonder, what kind of plan they have.
Right.
And sometimes you meet people, they'll come into the office and go, oh, I'm retired. And I'm like, well, where's your retirement plan? They're like, I don't have one. I'm like,
how'd you get here? Yeah.
You just retired, so you have the most money you're ever going to have. But what does 20 years look like?
Right.
So you start running out of things and going, well, what are you spending and what do you need to do?
Yeah.
So the planning to me is just crucial.
Absolutely.
I mean, we're biased, but
yeah, we are
okay.
Planners.
We're literally in our certification as planner.
Yeah. Well, great topic. Again, I think we'll just kind of wrap up from our perspective. Bear markets will come and go, and it's all about, again, having that plan, understanding where you are, what retirement's going to look like. And, in some cases, there's adjustments that have to be made, certainly if you have debt and those types of things. But, that also creates opportunity, right? And if you have that plan, I tell clients all the time, like, hey, the plan looks great right now, but things could change in 6 months to a year, but we have something to pivot from. We have something that we can start with, figure out what B, C, and D looks like. It's not, and that's the key to being successful.
Yeah. You need to review the plan. Don't just create it 10 years before retirement and then go, oh, I did it. It's all done. Because life circumstances change, not just market circumstances.
Yeah.
Right? Clients will tell you 10 years before retirement, this is what I want, and blah, blah, blah. And then, right before retirement or even in retirement, things change.
Yep.
They want to move closer to their kids or grandkids. That wasn't in the plan in 10 years. So you have to stay up with the things that are changing.
Yeah, absolutely. And laws change, so security claiming strategies, you have tax rates changing, all these things can impact the longevity of the plan. So how does that look on the tax side of things? Are we taking ordinary income out of your 401k or IRA versus long-term capital gains? How does that affect, Social Security and all these different aspects where, again, a lot of clients, to your point, they retire and, oh, this is all the, we meet people all the time, go, oh, I have this coming in, this coming in. I'm like, well, what about this? Because, that's a whole different tax scenario.
Right.
And, if you start taking all this, oh, just wait till take that. Well, then you'll be in a higher bracket and you'll have penalties on Medicare. I mean, there's so many moving factors that, again, having that cohesive plan where you can say, hey, we can do this, and this is going to save you taxes in the long term, and it's, your assets are going to last longer also.
Yeah, it's, to get back to that client in 2000, they never went back to work.
Yeah.
Right? Things didn't look good, but we adjusted, and they're both still alive 25 years later, 25 years older.
Sure.
And they're still retired.
Yeah.
While I've been doing this for a really long time, I've never had thousands and thousands of clients. I've probably had dozens, if maybe over 100 clients have retired. I've never had one client had to go back to work because the plan didn't work.
Right.
I have had clients go back.
Not because the plan didn't work.
But that was voluntary.
That's because their retirement didn't work. Yeah.
They go, I want to go do something. I want to be busier, and that busier means I might make some money.
Right.
But the plan didn't fail, so that they had to. And my goal in my career is that never occurs.
Right.
Every single client who wants to stay retired can. If they want to go back to work, fine. But I don't want the plan to not work so that they're forced 5 years later after being retired to go back to work.
Yeah, that's a key. And I think that's the strategy of everybody at VLP is, if we can plan properly. And, there are some times you have clients you're going, we planned for this. You're clearly spending more than you said. We have to have those conversations.
I've had those conversations. Yeah.
And that's not, they're actually, the information they gave for the plan, not accurate. So you have that from time to time.
Got to follow the plan.
Yeah, you got to follow the plan.
Yep.
And in some cases, there's room for that. But again, it all comes back to the planning. So, all right, in closing, bear markets, from our perspective, if you've planned right, they're opportunity, not an opportunity. This is a great opportunity for you to be able to continue to retire. And it gives us opportunity to do other things, rebalancing, repositioning. But if you have a plan, it shouldn't affect when you retire.
No, I would... again, if you've thought it through, now if you're going to retire tomorrow and you haven't put a plan together, that might be an issue. But think about it in a reasonable amount of time ahead of time, and you'll be fine. Yeah. Make sure you're taking into account the multiple areas that you're going to spend money. Not, I just need money for retirement. You go, well, what about cars?
Right. What about boats?
What about boats? Cars are a little more needed than a boat.
Yeah. You don't need a boat.
What about, hey, you'll probably downsize. And clients always say, I'm going to live in this house the rest of my life. I go, no, you're not.
Yeah.
The vast majority of people don't.
Right.
Because they don't want to live in that big house that they raised kids in. They go, I don't want to clean this thing, and the yard's too big as you get older. So you just have to anticipate things that are going to come up. And part of working with an advisor is we have seen these and we've experienced it. We've personally not retired,
right,
but we've worked with hundreds of people who've retired. And so we can bring that knowledge to somebody who you're only retiring once.
Right.
So, it's good to get that experience. And
I always tell clients, I said, list your goals in retirement. And I said, and if you miss any, I'll add them.
Yeah.
I go, I've done this long enough that I'll know where you're missing something. Yeah. So, but great. All right. If you like this video or others, please feel free to share and like our YouTube page. And again, if you have questions or you're thinking about your own planning or retirings out there, feel free to check out our website and make an initial consultation. We'd love to figure out how we can help you live greater.
Have a great weekend.
Yeah.
Thank you for listening to this episode of the Live Greater View. If you like what you heard, please subscribe to our podcast on iTunes or Spotify and recommend our podcast to family and friends. To learn more about VLP Financial Advisors, please check out our website at vlpfa.com. Thanks again.
And now for our necessary disclosures. Securities and advisor services offered through Cetera Advisor Networks, LLC, member FINRA SIPC, a broker-dealer and registered investment advisor. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned. Due to the volatility with the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results.